Tax loss harvesting is a proactive tax planning strategy that can actually save you a lot more in taxes than you might otherwise think. How does it work? I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Obviously, every investment that you make, you're wanting it to have a positive return and have growth for you for the long term. Yes, we use investments that are cyclical and no one knows the future. They go up and down in value. But yeah, your aim is never to lose money. However, when you do face those temporary losses in some investments that are just cyclical, or maybe you held a concentrated position, maybe individual stocks, something like that, that really declined in value significantly, and it's going to take a long time to recover, are there any strategies that you can do to turn that negative into even a little bit of a positive? Yes, well, there can be, okay? And the strategy is called tax loss harvesting, okay? And I want to share a little bit about how it works, but then at the surface, most people, when they're using tax loss harvesting strategies, they actually don't use it to their full advantage, and it can actually save you even more tax than what most people end up realizing. Let me explain. When you own investments outside of your tax shelter, so outside of your 401k, outside of your Roth IRA, those sorts of things. So if you just own an individual account or a joint account, okay, and by all means, you should fully max out your tax shelters. Max out your 401k, max out your Roth IRA, all that sort of stuff. But any dollars that you have invested above and beyond that, outside in other accounts, an individual account, a joint account, maybe a revocable living trust account, when you buy an investment, say you buy the S&P 500 index, okay, and you bought it here, and you don't sell it, and over time it goes up and down, and it goes up to here. And it's been more than 12 months that you held it, and then you sold it, okay? When you sell that up here, the difference between what you bought it for and what you sold it at, and I'm making things a little simpler than it might otherwise be with dividends and other things, but that difference is a capital gain. That's a gain. And when you sell that investment, as long as it's been over 12 months, then it's reported on your tax return as a long-term capital gain. What's that tax rate? Well, if you are in the ordinary income tax bracket of 0%, 10%, or 12%, then your long-term capital gains rate on your federal tax return is zero. Zero, that's right. You would still have to pay state tax on it, but it would be zero federally. That's fantastic. But what if you're in the 22%, 24%, or higher ordinary income tax bracket? Well, then that capital gain from buying that S&P 500 index and selling it here, that gain there would be taxed at 15%. Now, if your income's way up above certain thresholds, over $500,000, then your capital gains rate would be a little bit higher still. But for most of us, it's either 0% or 15%. Most people then are aware of that, and if you sell several different investments, say your S&P 500 you bought here and you sold it here, but what about if you bought the small cap index as well, because you've got a diversified portfolio, and you bought your small cap index here and it went up, but by the time you sold it, it was down here. Well, then you've got a loss. And that loss, when you have that capital loss, it will be used to offset any other capital gains, okay? Any other capital gains that you realized and had that year, right? So in that way, that loss is saving you 0%, right? If you're paying 0% capital gains rate, for most people, that means that loss is saving you 15% because you're above that 12% tax bracket. You're in the 22% tax bracket or 24% tax bracket. So that loss, that small cap index that you bought here and was worth this, but you sold it down here, that loss is offsetting gain, so it's only saving you 15%. Well, what if you captured losses when they occurred, and hopefully there's not many, but what if you captured losses and were intentional about not selling investments at a gain during that same year? So doing tax loss harvesting, but not capital gain harvesting. Well, then that loss, if you don't have any other gains, or if that loss covers up all the capital gains that you have, then you can claim that loss on your tax return up to $3,000 a year. So you can't claim the entire loss all at once, but only up to $3,000 a year, and then the rest of it you can carry forward to do the same thing, help you offset future gains or have a deduction on your return up to $3,000. We're all aware of this, but here's what most people don't recognize or don't strategize. If you've harvested capital losses and you don't have any capital gains to offset, then that $3,000 is a deduction from your ordinary income, from the rest of your income on your tax return. So that loss in that instance doesn't save you 15% in capital gains rates because there's no capital gains to offset. It actually saves you your ordinary income tax rate. Whether you're in the 22% tax bracket, 24% tax bracket, or up in the 30s, that $3,000 saves you that much in tax. That's right, and that's why obviously no one is aiming for having a deductible loss or a capital loss, but if you have one, if that's something that you've realized this year, I think this year to date at the time I'm recording this, even though the stock market has had a fantastic year, somewhere near 40% of all S&P 500 companies are actually negative year to date. So if you've held an individual stock, or maybe you've held a bond investment or an international investment that hasn't performed well, and there's some losses that you can capture, it can help save you far more than just a capital gains rate. It can save you 22%, 24%, or even more. We've got clients that during, go back to March of 2020, where we did some tax loss harvesting, some rebalancing during just the awful time period of COVID. We're still using those losses to offset ordinary income tax rates in this year, saving significant amount of tax dollars. So being strategic, being planful with your tax loss harvesting can actually save you a lot more tax than you might otherwise think. Where can you be on the hunt for some tax loss harvesting opportunities? Well, work with your certified financial planner, and yet again, if you're just maximizing your tax shelters, then this really doesn't apply to you, and that's a good thing. That's a good thing. You should optimize your tax picture and invest in tax shelters, because all the capital gains dividends, they're sheltered from tax, right? It's just dollars outside of those Roth IRAs, those 401ks, those IRAs that are subject to this. So how can you be aware of these opportunities? Well, like I mentioned, the first is when there's just cyclical declines. The S&P 500, a great example. Obviously, it's having a fantastic year, but on average, from a high point to a low point, the S&P 500 each year will drop about 14%, over 10%. You'll see an inter-year high point to a low point. And if you just happen to invest some dollars right at that high point, you might see a decline. And we certainly know that markets are cyclical, and large cap stocks, of course. Same with international, same with mid cap, small cap. And so cyclically, you might just see that, yeah, I have got an investment in my diversified portfolio that's actually down a couple $1,000s since I began holding it. And it's still one that I want to hold long term, but let me do some tax loss harvesting to be able to capture those losses. A second time you might be strategizing for tax loss harvesting is a newer strategy called custom indexing or direct indexing. Now, you're going to want to work with your CFP on this. This is where, depending on the amount of dollars that you have saved up, this strategy might make sense for you, where instead of owning an exchange traded fund of the S&P 500, you might own fractional shares of all of the underlying holdings, all 500 or so large company stocks. And because you own those fractional shares, you can actually look in the ones that of all 500 individual stocks, the ones that have losses, you could have a system that's on an ongoing basis selling those and capturing those losses. So that's the second way you can optimize your tax loss harvesting. And then the third I mentioned with COVID. Now, hopefully these don't come around that often, but a significant downturn, a bear market in the stock market. And we've seen more frequently over the past 20 years when one area of the investment world is having a bear market, then a lot of investments sort of, the correlation goes to zero, sorry for the jargon there, but there's downward selling pressure on a lot of risk assets. And if you just happen to be invested during one of those times, which inevitably you will, being aware, being cognizant of, okay, I still want to own these investments long term, but let's rebalance here while things are down so that we can harvest some losses. So that's a little bit of how tax loss harvesting works and how it can actually benefit you more on your taxes than you might otherwise realize. Just a couple pointers. One, Any tax loss harvesting to benefit you on your taxes has to be done by 12/31. So make sure that you're aware of that. This isn't something you can do right up until your tax filing deadline. That's one. Number two, you need to be aware of wash sale rules. That's right, wash sale rules, where you don't reinvest these dollars or reinvest dollars back into that same investment you're trying to take a loss on within 30 days. That's within 30 days before you sell or 30 days after you sell. Then that's a wash sale and those losses will be disallowed. So work with your certified financial planner on that. As we round the corner, we're in the fourth quarter here looking at tax strategies. You may not have many opportunities for tax loss harvesting. That's a good thing, but be on the lookout for the strategy. Work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.